Pi Network's core team just published what they're calling a vision statement for the next phase of Web3 adoption. The language is deliberately bold, futuristic, positioning blockchain not as a technical curiosity for crypto natives, but as a worldwide opportunity accessible to mainstream users. This isn't accidental phrasing, it's strategic messaging designed to differentiate Pi from Ethereum, Solana, and other chains that require technical knowledge and upfront capital. The central thesis: Pi's mobile-first design enables faster mainstream adoption than conventional blockchain onboarding methods. Instead of downloading wallets, managing seed phrases, buying ETH for gas fees, and navigating DeFi protocols, Pi users download an app, press a button daily, and accumulate tokens. The friction points that prevent mass adoption elsewhere. Pi claims to eliminate them entirely. This announcement reinforces Pi's founding mission, democratizing cryptocurrency mining. Traditional Bitcoin mining requires expensive ASICs, cheap electricity, and technical expertise. Ethereum staking demands capital and infrastructure. Pi, just a smartphone and daily engagement. The team is doubling down on this accessibility advantage as energy-efficient blockchain solutions gain mainstream attention globally. The messaging targets emerging markets where smartphone penetration exceeds computer ownership, where electricity costs prohibit traditional mining, and where populations seek financial inclusion outside legacy banking systems. If blockchain's promise is financial democratization, Pi argues their mobile approach is the only scalable path to delivering it. The announcement heavily emphasizes Pi's global community, now exceeding 35 million users, as its greatest competitive advantage. This isn't just user count bragging, it's positioning community size as the moat that prevents competitors from replicating what Pi has built. Network effects matter in crypto. The more users a platform has, the more valuable it becomes, attracting more users in a compounding cycle. Pi's strategy is community-driven growth over institutional adoption. Rather than pursuing venture capital, exchange partnerships, or whale investors first, they're building from grassroots up. Pioneers and newcomers in official channels create organic momentum that extends the ecosystem without depending on external capital or institutional blessing. Hold up real quick. We're not done. If this breakdown of Pi's strategic positioning is clarifying what they're actually trying to build versus what the headlines say, show some appreciation with that like button. And if you're serious about understanding project strategies beyond surface-level announcements, subscribe to TJ Crypto World right now. We're analyzing business models while everyone else just reads press releases. Alright, let's talk about whether mobile mining creates actual value. Let's be precise about Pi's mining mechanism because, honestly, language really matters here. Pi's mobile mining isn't computational mining like Bitcoin's proof of work. You're not solving cryptographic puzzles or validating transactions. Instead, you're just pressing a button in an app once every 24 hours to prove you're an active human user. This keeps engagement up and, helps prevent bot accounts from gaming the distribution system. The Pi team frames this as energy-efficient mining, technically accurate since it uses negligible electricity compared to Bitcoin's massive energy footprint. As climate concerns around blockchain grow globally, Pi's minimal environmental impact actually becomes a genuine selling point. But let's not confuse energy efficiency with real economic value creation. Here's the uncomfortable question Pi's announcement doesn't address. What actually creates Pi's value? Bitcoin's value comes, at least in part, from mining difficulty and electricity costs. There's real resource expenditure securing the network. Ethereum's value connects to transaction fees from DeFi activity, NFT trading, and smart contract execution. So, what's Pi's value driver? The team would probably argue it's the network of 35 million users creating economic activity once the ecosystem fully launches. Fair point. Network effects do create value, but network size alone just isn't enough. MySpace had massive user counts. Facebook had engagement and monetization. Pi has users. But what's the monetizable activity beyond just token speculation? Credit where it's due. Pi genuinely lowered barriers to blockchain participation. Millions of people in developing markets who couldn't afford Bitcoin mining equipment or Ethereum gas fees managed to accumulate crypto through Pi's app. That's not nothing. It's actual progress toward financial inclusion, even if we're skeptical about other aspects. The real question is whether this inclusivity translates to sustainable value. Giving 35 million people tokens is step 1. Creating economic infrastructure where those tokens have utility beyond speculative trading is step 2. That's where Pi's success or failure will ultimately be determined. The announcement mentions pioneers watching updates closely to assess real-world application potential. This really reveals the community's sophistication. They're not blindly optimistic. They're evaluating whether Pi's mobile mining leads to functional DeFi, actual merchant adoption, cross-border payments infrastructure, or if it just remains a social experiment with IOU trading on unofficial exchanges. This kind of skepticism is actually healthy. Communities that question, pressure, and hold teams accountable create better outcomes than echo chambers that just dismiss criticism as FUD. Pi's 35 million users include both true believers and informed skeptics watching closely for execution delivery. Now we address the elephant in the room that Pi's inspirational Web3 announcement, strategically avoids 190 million Pi tokens unlock in December 2025. This isn't a small unlock. It's a supply shock that fundamentally impacts Pi's economics, regardless of how compelling the vision sounds. Current IOU trading shows Pi valued between 30 and 40 cents on unofficial exchanges. That's the market's assessment of Pi's value absent major exchange listings. When 190 million tokens unlock, holders who've been mining for months or years finally gain liquidity. What percentage immediately sells to realize gains? Even if it's just 20%, that's 38 million tokens hitting supply. The Pi community is genuinely divided on what this unlock means. The optimistic interpretation increased liquidity attracts larger traders and institutional interest, token velocity increases, economic activity accelerates, and price finds true market value potentially higher than current IOUs suggest. The pessimistic interpretation supply overwhelms demand, IOU prices collapse below 30 cents, pioneers who held for years realize losses, sentiment sours, mining rates drop, and the project enters a death spiral where declining enthusiasm reduces the network effects that supposedly create value. Compounding the unlock pressure, returning users who paused mining are now reactivating their accounts, which is, increasing the daily Pi issuance rate. This move is economically rational. If tokens are unlocking in December, it just makes sense for inactive miners to come back and try to maximize their position before any liquidity events. But here's the thing. It actually creates additional supply inflation, and that happens exactly when the network really needs supply discipline. Pi's economic system wasn't designed for these simultaneous large unlocks and mining rate increases. The team originally designed gradual distribution, assuming steady engagement from users. But when millions return at the same time, well, the issuance model gets stressed in ways that really test its resilience. The core team's decision to publish this bold Web3 vision statement right now, it's not just a coincidence. As economic pressure mounts from those upcoming unlocks and with IOU price stagnation, they're kind of planting positivity and trying to refocus the community's attention on the long-term vision instead of just short-term price concerns. Honestly, this is smart crisis communication, shifting the narrative from will price crash to we're building the future of Web3. But whether it's effective really depends on execution. If December unlocks go smoothly with minimal price damage and ecosystem utility launches start to accelerate, the inspirational framing looks, pretty prescient. But if unlocks trigger a lot of sell pressure and utility remains just vaporware, it's going to look more like a distraction from problems the team just can't solve. Before we wrap up with my assessment of where Pi actually stands, I really need to see that engagement. If this analysis connecting visionary announcements to economic reality is giving you a perspective that others just don't have, go ahead and hit that like button right now. And for those of you who want analysis that looks at both the project's potential and its risks at the same time, make sure to subscribe to TJ Crypto World. Alright, here's my honest take on Pi's current situation. Okay, let's separate hype from reality for a second. Pi has successfully onboarded 35 million users to crypto, people who otherwise probably wouldn't have participated at all. That's a genuine achievement in terms of financial inclusion. They've managed to keep community engagement going for years, even without any token value, which is honestly impressive given how most crypto communities tend to fragment when prices stagnate. Plus, they've pioneered, pun intended, a mobile-first distribution model that other projects are definitely going to study and maybe even replicate. So whether Pi ultimately succeeds or fails, they've shown that smartphone-based blockchain participation can actually scale to tens of millions of people. What Pi hasn't achieved is converting user count into economic value. 35 million users without clear monetization paths, merchant adoption, DeFi activity, or major exchange listings makes this more social network than blockchain network. Facebook's value isn't user count, it's advertising revenue from engagement. What's Pi's revenue model beyond token appreciation? The mobile mining democratization is process innovation, not value creation. Making something accessible is step 1. Making it valuable is step 2. Pi is still executing step 2, and December's unlock will stress test whether they've built sufficient utility to justify whatever market cap emerges. The December 2025 unlock is the most important event in Pi Network's history. It's the moment where speculation meets liquidity, where believers can cash out or double down, where market price discovery finally occurs beyond fragmented IOU markets. 3 possible outcomes. Outcome 1. Successful launch. Major exchange listings accompany unlocks, ecosystem utility launches simultaneously, demand absorbs supply, price stabilizes above IOU levels, pioneers remain engaged, and Pi enters its next growth phase validated by market acceptance. Outcome 2. Controlled decline. Unlocks proceed without exchange listings, supply exceeds demand, prices drop 30 to 50%, some pioneers exit, community shrinks but hardcore believers remain. Team continues building through bear market, potential future recovery. Outcome 3. Collapse. Massive sell pressure overwhelms limited demand, prices crater to single-digit cents, community sentiment collapses, mining stops, project effectively ends despite core team's continued effort. I'm watching Pi with informed skepticism. The community size is real. The distribution innovation is genuine. The mobile-first accessibility matters, but none of that guarantees economic success. Projects with better technology, larger communities, and more funding have failed because they couldn't convert users into sustainable value. The Web3 vision announcement is appropriate. Teams should articulate long-term goals, but vision without execution is hallucination. Pi needs to deliver utility, secure listings, manage December, unlock smoothly, and prove that 35 million users translate to network value rather than just network size. What I'm watching: exchange listing announcements before December, ecosystem utility launches, DeFi, payments, anything with transaction volume, core team transparency about unlock mechanics and economic management. Most importantly, how December unlock prices hold or break determines whether Pi's vision remains viable. If Pi survives December with community intact and price respectable, they've earned the right to pursue their Web3 ambitions. If December destroys confidence, the visionary announcements become irrelevant. Alright, crypto fam, that's the complete breakdown. Pi Network's Web3 positioning, their community-driven growth strategy, the mobile mining reality check, and the December unlock that decides everything. Massive respect to everyone who made it to the end. You're evaluating projects through both vision and economics, which separates investors from speculators. Before you go, check out my latest analysis on the next big thing in crypto, where I break down what could be the next game changer. The community's been sharing incredible insights in the comments that add layers to the discussion. Drop your thoughts below. Are you bullish or bearish on Pi heading into December? Do you hold Pi, and what's your plan for the unlock? I read every comment, and the Pi community always brings thoughtful perspectives. Until next time, this is TJ from TJ Crypto World reminding you, vision statements inspire, economics decide. Understanding the difference between what projects promise and what they deliver is how you survive crypto. Stay sharp, stay skeptical, and never confuse community size with community value. Peace.